Good morning, good afternoon, and good evening, everyone, and welcome to Alternative Funding to Start and Grow Your Business. My name is Colin Mahan, and I'm a program manager at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit dedicated to enabling entrepreneurs from all over the world to realize their maximum potentials and grow. As you may have just seen in the chat, the Nasdaq Center, along with our partner Mentor Cloud, launched a free mentor matching platform for entrepreneurs called Mentor Makers. You can create your own advisory board to guide and inspire you with in-the-moment mentorship from topic experts and professionals dedicated to providing exceptional mentorship to entrepreneurs across all races, industries, and geographies. So find or become a mentor today by using the link in the chat. Mentorship matters to all entrepreneurs. As we know, their success is dependent on it. Quick housekeeping item, we're going to open up for live Q&A at the end of the event, so please submit your questions in the Q&A function at the bottom of your screen throughout the presentation. Now, none of what we do here at the center could be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, BPM, and NZTE. We're humbled by their contributions. During these still somewhat unique times, we're curious on how sentiment is among the entrepreneurs we work with. So we're going to start by taking a quick poll to let us know how you're doing. So just let us know. The first question, how are you feeling? We've been asking this since the beginning of the shutdown. And the second question, what's keeping you up at night, helps inform the responsive programming that we at the center provide for you, the entrepreneurs we serve. So appreciate you guys taking a moment to fill that out. Both of these will help us understand how we're going to guide our responsive programming, and also will help our panelists today understand where you guys are thinking. So appreciate that. I'm going to give this another second or so, but I don't want to waste any more time before jumping into this awesome conversation that we have for you all today. So I'm going to end that poll, share these results. Looks like optimism is on the rise, but totally understand that there's some anxiety, fear, and just survival mode out there. And finance, drum roll, is the topic for today. So hopefully we'll help you sleep a little bit better by addressing some of those finance related issues. So without any further delay, please join me in giving a warm welcome to our panel in the chat. First of all, our moderator, Paloma Vidgen. She's in SME segment strategy for women entrepreneurs at Bank of the West. Sara Razavi is the CEO of Working Solutions CDFI. And we have Alethia Mendez, Division President, Elevating Black Women Entrepreneurs at Grameen America. So thrilled to have all of you and excited for this discussion. Paloma, over to you.
Great. Thank you so much, Colin, and good morning, everyone. My name is Paloma Vidgen, and I work at Bank of the West. For those of you who aren't familiar with Bank of the West is a full-service bank operating in 19 states. We offer everything from retail and consumer banking, business banking, commercial banking, as well as wealth management services. And we're part of the BNP Paribas Global family. At Bank of the West, we're a fundamentally different bank. Our leaders consider issues like gender equality, diversity, and our impact in the world when making decisions. And I'm very fortunate to lead our women entrepreneurs segment at the bank, where I get to put together strategies and solutions to help women entrepreneurs as they build and grow their companies. And I'm super excited to be joined by some of our actual partners, and I'll let Sara introduce herself.
Thanks so much, Paloma. My name is Sara Razavi. As Colin mentioned, I'm the CEO of Working Solutions CDFI. Working Solutions CDFI is a nonprofit community development financial institution. That's what CDFI stands for. And our mission is to serve underrepresented populations. We provide entrepreneurs with small business grants and microloans of $5,000 to $50,000. Our niche and focus is startup and early stage businesses. In fact, over 60% of our portfolio, when they first came to us, were a business with less than 1 year in operations. And in total, over 80% of our portfolio is less than 5 years in business. So that's what we know, and we know really well the concerns and anxieties. We've been around since 1999. We're headquartered in San Francisco, but we serve the 9 Bay Area county. We're a staff of 20, so we also understand when we're talking about small and medium and what some of our partners at extra large might be, but we can appreciate what it takes to run a small business. We are a CDFI within the larger national field of CDFIs. So if you're not based in the Bay Area, there are other organizations like us who can serve you. And we'll talk more about that. But great to be here.
Great. Thank you so much, Sara. And Alethia?
Hi. Hi, everybody. Great to be here as well. Thank you, Paloma. And yes, as you've all heard, my name is Alethia Mendez, and I'm the division president at Grameen America. And what Grameen America does and what we're really focused on is working with women to support women with financial access to microloans, asset building, credit building, training, and support. And we're really focused on supporting and building and really being able to provide the resources to women entrepreneurs, because we really feel that women are at the heart of our economies in our communities, and being able to build and support them reaches whole families and communities as well. Grameen America is also a national program. We're a nonprofit and a community development financial institution as well. And as Sara said, we will talk a little bit about what all that means, but we provide microloans as well as financial literacy, education, training, and we use an interesting, unique lending approach using a group model. So we'll talk a little bit more also about what that means and how it works. But we are located in 18 cities across the United States. And over the time, our loans are started about $2,000, but each opportunity gives you a way to be able to grow that credit and be able to access further and increasing sizes of loans. So thanks all, and look forward to chatting here.
Great. Thank you so much. So as we said, today's topic is really on alternative financing. And so we want to get into those strategies and different solutions you may not be aware of. I think entrepreneurs typically think of starting up and venture capital, but we're going to share and shed some light on those other alternatives that you have out there. So let's start by explaining how your type of organizations, both microfinancers and CDFIs, work with business owners. Sara, let's start with you on that one.
Sure. I'm watching the chats a little bit. So just a reminder, our organization name is Working Solutions CDFI. We can also just go by Working Solutions. And we provide 5 to 50,000. That's a common range for microloans, some folks are wondering. So as a lender, I think part of the distinction is you have different ways to create your capital stack. You can do that through notes that you would have to repay, and those notes have variable terms. And then you can also do it through equity, as Paloma just touched on. Lots of folks really immediately think about equity because who wants to pay money for money? It can become costly, especially when you don't have any kind of strong revenue early on. But a typical client for us hears about us through events like this, by word of mouth, their banker, because while every lender wants to lend, they have different credit considerations, and we consider that the different kind of risk profile that they're willing to take, or it's just not cost effective for some bank for various reasons to provide a loan at a certain interest rate for a smaller dollar amount. So most larger banks tend not to do microloans for businesses. They tend to outsource that to partners like Grameen America and Working Solutions. So we get a lot of referrals from some of our bank partners who have a client who's now in need of some loan product, but they don't want it for themselves personally, they want it for their business, and we can talk a little bit more about that as well. And so they refer them to us. A typical client for us is usually, as I mentioned, very, very early on in their business cycle. And we tend to be the first to believe in them. We kind of have that tagline for ourselves. Because as a nonprofit lender, we have a mission-led approach. Our goal is to serve those who, for various reasons, have limited access to capital. These could include, but are not limited to, new or early stage businesses who are pre-revenue or definitely pre-profitability, limited low, or even bad credit history, or simply are just new to debt financing. And just to demystify these words, debt financing simply means that you're new to taking out a loan. We get to that first yes for you so that future lenders and future investors can see your business has a credit history and that you have some traction. So we report to business bureaus. We also report to personal credit history as well. I'm sure Alethia might touch on this as well, but essentially all folks who you're dealing with around capital are going to be looking at very similar things. It's just what they do with that information that distinguishes them from each other. And sometimes what they do with that information has to do with their boards or how they were structured, what their founding mission was. For both of us, I would say our goal for both organizations is to serve those who have been denied credit for a multitude of reasons in the past. We take that risk at Working Solutions, at least, by starting out with small loans in the hopes that you not only grow in our portfolio, but that you can grow into other opportunities, whether you choose to take on greater debt through some of our partners like Bank of the West or some of the larger banks, or that you step into equity once you have a better sense of how your business revenue is moving and some of the considerations that you might not have thought about very, very early on.
Great, thank you. And Alethia, anything you want to add? I know we're getting into a little bit different on the differences on Grameen America and your model, but anything that you would add to just general in terms of these sorts of organizations?
Yes, no, thank you. I think, as Sara said, it is particularly for microfinance organizations, community development, financial institutions, it really is mission focused. And so if you think about it, banks, traditional banks, larger size banks, right? They are working, providing capital, providing other financial products, but they're able to do so at a particular stage or particular level in terms of financial identity, whether that be your credit being at a particular position, whether that be other representations of collateral that you may have, right? All of these are things that are being looked at. And I think what I would say that from these microfinance organizations or, CDFIs, because we are focused on being able to sometimes, and at Grameen America, be, for many, the very first time individuals are working with a formal financial institution. It is a place and a space where you can get maybe the type of hand-holding or guidance, a more closer and intimate relationship and touch point with that financial institution, being the first time, having that first experience, and really having a person, an individual, be able to walk you through these areas that are going to be looked at, to help you think about those, and sometimes even take the steps to prepare for what is going to be needed, so that they can receive an access to something as simple as a microloan and or any of the other financial products that are available.
Great, thank you. Now, Alethia, I'm a banker, but I think probably it wasn't until a decade into my career I actually heard the term CDFI, and microlending was not something that's super familiar. And so I have to imagine for business owners, it's the same case. So how do people find you when they have a business, they're looking for that financing?
Yes, so Grameen America is, I think, takes an interesting approach, because one where follow very grassroots approaches, as opposed to what you would think about traditionally. When you think about financial institutions or banks, typically the bigger banks, you find a location, you find an office, right, with the sign, the bank sign, and you go into their office and you hope that you can find a representative to talk to about your needs. But Grameen America, as I would think many of our CDFI friends we take a different approach to that, because understanding that there is this large population of need, that are being underserved and don't have this access. We position ourselves both in the place, the space, and with relationships that are recognized, are trusted. And so Grameen America takes that relationship trust-based approach, one, by working directly in the communities where we're operating. And so, across our 18 cities, you may actually find a Grameen representative walking in your neighborhood, walking down the block, popping into, what may be, another local business that you may patronize and or, have a space, or using a space in. And so it's a different approach, and I think thinking to banking, right? In that you can take the touch point to the individuals, to the people themselves, and you can present yourselves, right, as that trusted person that you can work with. The other channel, of course, which is an important one, is I mentioned our CDFI friends, right? We're not, all of our organizations are not everywhere, but the fantastic thing is that there's this network of like-minded, organizations that are looking to provide this level of support, these level of small loans. And so that gives an opportunity to be able to say, hey, I might have gotten in contact with a lovely lady, looking to start her business, really hasn't had a loan before, but she's located in, a neighborhood where we may not be. And so that does give us the opportunity to work with our partners and be able to send them over, pass the name and contact over, make an introduction. And sometimes it is that simple introduction and that connection that makes or breaks that person's ability to access financing and access the support and other resources that she may need or he may need.
I love that, the network upon network to get people access to capital. Sara, how does working with something like Working Solutions differ from working with a bank? I think we've all experienced some aspect of working with a bank, but where do you really have those differentiators?
I think it's a lot about, for one thing, for most CDFIs, we are not depository institutions. So we will not replace your bank. You should still hold a bank account for your checking or some sort of financial entity that can provide you a depository option, as well as, so that you can pay your vendors, get paid, all of those great things. But the difference is our mission versus bottom line. Most banks have a for-profit model. Some CDFIs have a for-profit model. So what I'm going to say is not like across the board. And in fact, we have many of our bank partners, like Bank of the West, who are extremely socially minded and socially responsible. But we, as a mission-minded entity, also receive grants to then deploy out to the community. We mix that with other capital that we borrow. So we can have a higher, what we call risk tolerance, to consider, your credit score might not be what the banker felt was suitable for their product, or you just might not have a credit score. You recently arrived to this country, you have a pretty light credit profile, or everything you've done has been by cash so far, so you haven't built out that credit history. Regardless, we then take that information and say, we'll be willing to take this risk because our mission, and we've been founded on the principle that we need to serve many who have been limited in their access. And what we mean by limited are not that people just don't want to give money to somebody. It's rules and regulations are set up in a way that they either intentionally or unintentionally discriminate against a certain population. And those discriminations can come through in the kind of entity you have. Startups and early stage businesses usually don't get funded through debt financing because you have to show a history of revenue. You have to show a history of proof of concept. And that's why most people end up for early stage and startup go into that equity mindset, because a lot of times they've been turned away for a business loan. What we found, usually people tend to capitalize their businesses through their own savings, through checks, through credit cards, personal credit cards and business credit cards, and then eventually a more formalized loan. But they've been refused so many times that they go, okay, you know what? I don't need to go through that process again. I'm gonna just jump to an equity consideration. So I think that's the difference, is we look at very similar information, but we just have a different end goal. And similar to what Alethia said, just given our business models, given our missions and our our purpose, we take time. Our incentives are by how many people have we served, in which categories, who have been underserved. And so it's not about, did you close that loan? How high was it? How much percentage did you get? We monitor that stuff. It's good information for us to have, but we don't provide our bonus structure or our incentives internally around that. What we are really often reviewed by is, who have we served and were they underrepresented, undersupported?
Great, thank you so much. And I think, Sara, you also brought up the great point. You should still be establishing a banking relationship for your deposit needs, and especially to accept payment in this digital world. Being able to accept payments online, or it's become such a critical feature for business owners. Alethia, Grameen America is doing something very different in this space, and I'd really love for you to get into, what does your decision-making process look like? What are your key factors for the ability to say yes, but get into the model itself. It's really different and special.
Yes. So at Grameen America, I think the best way to describe kind of our approach, or our evaluation approach, one, in terms of the loan, they're character-based loans. And so what I mean by that is, where typically you do have, whether they be the traditional banks and or other, CDFI and financial service providers, they do look at the typical things at the end of the day, like your credit score, what your debt profile may be, the types of other lines of credit and or things that you may have. But as Sara said, it is what you do with it. It is what we do with it that does make the difference sometimes, at being able to get it versus not being able to. At Grameen, we take a very different approach. One, we actually do not use credit scores as an input to the program. So that's unique in the financial realm and financial services. But we really do believe that an individual doesn't have to be defined by their past behaviors. That really, and that doesn't have to define what their current ability or future success can be. So using a character-based approach really means that, one, we will look at your actual behaviors. Are you doing what you say you're going to do, or meaning what you say you're going to do, and doing what you mean? That can look like something as simple as your follow through on showing up to an agreed upon day or time for a meeting. Those types of things, right, demonstrate your ability, one, to something that you've committed to be able to follow through on. And that is, in a sense, what being responsible is, in its most simplest terms. And that can be applied and translated into the way you can manage a loan. And so Grameen America takes that thinking, or that philosophy, and then applies it also with kind of a community-based approach, in that we're a group lending model. And a group lending model means that we will work with an individual, but have her have an opportunity to come together with 4 other women who are, entrepreneurs, whether that be that they're at the startup phase, getting ready to launch their business, or already at the operating phase, where they're up and running and need investment capital to operating capital to fuel that. But the mix of the group doesn't matter. These women come together, form kind of a network, and that network doesn't take any responsibility for the liability of the loans. But what it does provide is one, a real ability to assess, right? Each individual's level of responsibility, because if it is somebody who knows you, knows your capability, right, they're actually better placed to be able to say and describe whether or not you would be a good fit to receive a loan and whether you'll be capable of managing that. So we take advantage of that as part of our evaluation or kind of unique underwriting process, as a financial service terminology likes to use. And we use that to basically say, yes, let's move forward in being able to provide each individual in that group a loan, or for whatever reason, sometimes if the woman may decide and say, like, this is not, this isn't something that I think works for me or is a good fit for me. And that is a self-selection in terms of being able to move forward. But it doesn't preclude her from having that door open in the future. So interesting approach to lending. I definitely know from my time at Grameen. Before that, I had never seen this type of approach to lending. It is not something common, but here in the United States, Grameen uses this approach. And because of it, or through that, successfully, we've been able to work with and serve over 138,000 women, over the last 13 years.
That's awesome. And just one kind of question to clarify, Alethia, what's your typical timeline? That seems like a much more encompassing process, but what should a borrower expect?
Absolutely. So to actually to access the loan capital, it's really a process that concludes itself within a week. So it's actually a fairly fast turnaround. Sometimes I will say that the process for forming a group, because that's the first place that this starts, coming together with 5 women with kind of within your own network. That is the place where probably most of the time gets spent, because the idea is that you want to form a group with individuals who, one, you're going to feel comfortable to spend time with on your journey, on your entrepreneurial journey. 2, these are women who are going to be able to, as part of your network, right, share best practices. You're going to be able to engage with each other, talk through sometimes some of the challenges that come up and obstacles along the way. And so, this sometimes can take a little bit, but from the time that's ready to go, we usually will turn that loan within 5 to 7 days.
Awesome.
Turn that loan around.
Thank you. And Sara, from a CDFI perspective, I know you're looking still at a lot of the same documents a bank would be looking at. What is your timeline typically for a loan request?
Yeah, it's we've automated quite a bit, but our biggest value add is making sure you can speak to someone throughout the process. It's very similar to what Alethia said. Many of us CDFIs are judged on what we call our assistance. They call it technical assistance, consulting, and we do that both before the loan has closed and also after the loan has closed. In our world, we call it pre-loan and post-loan technical assistance. And that's very valuable. And again, it's something we get judged on quite a bit. For us, it's usually about 2 to 4 weeks from the moment you touch our simple application online. All of this, as similar to what Alethia was saying, a lot of this will be self-driven. We're going to ask, we've simplified depending on the amount you're asking for. You're going to be asked for fewer documents at a lower dollar amount. So the reason many lenders, and this could be true for any kind of product you're looking at, the reason lenders are looking for documentation is to verify that you will pay back. Do you have, you said you have a business, I need to see a business license, business registration. You said you have a brick and mortar, I need to make sure to verify that address. All of that is a checks and balances thing. So if you're one to get annoyed by people asking you for verification, loans are going to annoy you. But, and typically lending, we just have to get these things verified, because if you look at it just from, back into it, we're handing over a large sum of money and we're asking for you to pay back incrementally. And depending on who you're talking to, that incremental payback can be over a long period of time, can have an interest rate that's high or low. But ultimately, that's the principle, right? It's a trust principle based on having just met. So you're going to have to, have a little bit of patience with documentation. We at Working Solutions and many CDFIs have tried very hard to limit the application requirements based on the dollar amount. So just expect, if you've got a smaller dollar loan, it's going to be a faster turnaround because you have fewer documents to provide. But if you're the type of person who doesn't want to provide documents, you could be sitting in our queue for a while.
Great comment. So in addition to financing, Sara, you touched on this a little bit, and I think Alethia, you have as well, but Sara, what should a borrower expect when they're working with the CDFI?
Yeah, again, you're going to expect a high touch in the industry. It just really means that you're going to be speaking with someone. If you don't understand an email, there's a contact number you can call, and you're not going to be sent to a general call center. That's a huge value, but it also means because we're providing that throughout our portfolio, things might be a little slower than, say, a fintech that is more automated, but you're going to have different requirements to qualify for that financial entity, that fintech. So I always tell people you're balancing, different needs. If your need is speed and you qualify for it, more power to you. Go and get that loan. But if your need is someone who understands your particular situation, and again, most often with startup, early stage, limited capital, credit history, you're going to need someone who kind of looks at and is able to communicate with you at a longer clip. So that's what you can expect from your experience with us, and I think it's a huge value, but it's not for everybody. And I think I'm seeing in the chat a couple of questions. We're both micro lenders. Micro loans in United States tend to be defined under 50,000. In other parts of the world, they have other definitions, but for the United States market, it's 50,000 or less, and the range is usually $5,000 to $50,000. Consumer loans tend to be less than 10,000 as a general, and a lot of small businesses mix up their personal financing with their business financing, which is fine, but we hope you decouple it soon. It serves you, your tax purposes, your mental health, to have those quite separate. But at any rate, some small businesses end up running their business on consumer loans initially. They've kind of repurposed it for their business, but you can be very honest with us. And when we consider how much debt to provide you, we're looking at your global debt capacity. How much do you have outstanding personally? How much income do you have, maybe through a secondary source of income, because you're still you're still working whilst trying to stand this business up. All of that informs what we consider as a lender, your capacity to repay. And I use these terms, everybody, because the intent for me for this conversation is to, and always for Working Solutions, is to demystify, to take away some of these words that sound like jargony. They help our industry because then we know we're all talking about the same thing. But for somebody who's out of the industry, it might sound confusing. So that's what capacity to repay means. It means how much money do you have available to repay your debts.
Great. Thank you, Sara. So Alethia, I think the goal of all of our institutions is to help businesses build and grow and continue to succeed. So typically, like, how long are you working with a client before maybe they get to the next level in their business life cycle? How do you help them scale and then, maybe move on to a traditional borrowing relationship at a bank?
The beautiful thing is that with many of our types of institutions, right, there's really an opportunity to build a relationship and then obviously take that relationship, right, which is different than getting a loan. The loan is a product, is one of the products that our institutions provide, but many times, especially at this very early stage, and or if it's the first time or you're new to working with a financial service provider, you want to be able to have someone you can talk to, someone who you can just, you can explain what's going on, and they'll help work through that with you, and give you options and give you information, right? That's the assistance, the technical assistance that Sara was referring to. That helps to build your knowledge and even ability, right, as you continue working and trying to build and fuel your business, right? And that's really, really important. And so I think part of the value of being able to have relationships with organizations like Grameen America, like Working Solutions, and our CDFI friends in the ecosystem, is that you'll be able to establish get access to a financial product and access to fuel that business, but then you'll also along the way be able to gain more information, more knowledge, practice, and build the habits that are going to make you successful. At Grameen, we've been able to see, and I always say we have the privilege of being able to create an experience in such a way that many of the women who we work with stay with Grameen long term. And that's always fantastic, because we definitely know that we are sometimes and really good at working with that very early stage business. But it's beautiful to be able to partner along the journey of that entrepreneur as that business is growing. And as that business is growing, continuing to provide the financial resource as well as the technical assistance resources that continue to just strengthen her overall ability. And so, at Grameen, our loans work at 6-month intervals, a 6-month loan cycle. And so what that just means is that it's over the tenor of the loan, or over the period of time of which you're repaying that loan at Grameen is 6 months. That varies from institution to institution. I believe Sara said that, some institutions have longer tenors or longer periods of time for which you may have the loan and you're repaying that loan, and others have it for a shorter period of time. And, obviously the idea is to figure out which works best for you, what the frequency, right, that you are going to need injections of capital, right? And how we can put that to work so that it best serves the growth of your business.
Great, thank you. And Sara, what are some of the common barriers you find when a small business needs that capital infusion? And maybe they've tried a few different options and they come to you, or maybe they do come to you and they're still, maybe it's their capacity to borrow. Like, what are those typical barriers you're seeing from business owners?
Yeah. So one of the things we typically find, and it could just be because folks might have gone to other lenders and didn't qualify for them, but sometimes, a lot of times it's timing. You needed that money yesterday and you're looking for a term loan. Term loans by definition are usually for a period of time, and it could vary. Our term loans are 3 or 5 year term loans. Depending on the institution you're working with and the interest rate they charge, sometimes the longer the term, And the smaller the interest rate, while it might be in the long run expensive, on a month-to-month cash basis, you're paying less. And so you end up wanting to do something longer because you're paying incrementally over time. Again, this could apply to any kind of loan. But timing is a huge thing. Folks are stressed out, they have payroll, and they're like, wow, I need a loan right now. Those are not the typical uses of a term loan. Payroll, unfortunately, is not, what's coming. Usually you want a term loan for something in the future that you're trying to build. So you use it for working capital, you use it for some sort of build out, tenant improvements, those kinds of a future product. That's what you tend to use a term loan for. If it's a bridge that, oh man, I just need that contract to come through and I need some capital in between, you'll be looking at probably something on a shorter term. But oftentimes, shorter terms, you're going to be paying for it, more for it. This is just the way business and life works. There are probably three things: people, money, and time. You're always going to be needing all three of those. And if you don't have one of those, you're probably going to be paying for it. So if you don't have money, you're going to be paying for it in time or people. It's called sweat equity. If you have a lot of time but don't have money or people, you get the idea. You're going to kind of keep having to balance these out. So I think the most important thing for any business owner is to look at the terms of the agreement. And if the terms are not transparent, as many lenders have tried to hide behind really vague terms, if the terms are not transparent, walk away. That's what's called predatory lending. When you can't figure out what's the APR, what interest rate am I paying? Why aren't they using the term APR and they're using some other term? It's because they're hiding behind the fact that they might be charging you a lot to get you money very quick. The unfortunate thing is if you needed money for something that's already happened, it's a hard bind to be in. And that's when it's a harder strategic decision of, well, what do I need to cut back on? What can I cut? How can I manage my cash flow? Rather than how can I inject temporary debt capital to make my business float.
Great. Thank you so much, Sara. So as we wrap up the not live portion of this, I wanted to finalize with one question for both of you. If you could provide one piece of advice to a small business owner today, regardless of their location, business type, or where they are in their business journey, what would it be? And I'll start with you, Sara, or Alethia, whoever you were both going there.
No, I would say that, obviously if you're thinking about how to finance your business, you're exploring your options already by joining this webinar today, you're already on the right track, right? Being able to hear organizations such as ourselves, working with Bank of the West, right, where you're already doing the right steps to explore your options. But what I would say in terms of advice for kind of emerging business owners and businesses here is that it's really important that you choose the right loan for you. And what I mean by that is that, Sara said the terms, the size, it's always nice and it's always attractive when, we've all gotten that letter in the mail that says like, oh, you're pre-qualified for X number of dollars. And you're like, oh, wow, what did I do to deserve this? But just because it says it or just because the opportunity may be there doesn't mean that that's the right thing for you to do. And so really taking the time to understand what the purpose of the financing is for, what your intention of using that financing is, right? Make a plan. Make a plan. It doesn't have to be a big fancy business plan, but you should have an idea about if you're looking to buy equipment for your business, right? How much does that equipment cost? how much do you think you're going to be able to produce or generate from that equipment, right? How does that imply and get inputted into the sales that you're going to be able to make, right? Because that's good. That's always your source of revenue, right? That's the source of money that you can earn. And obviously that's going to be the source and the place, right, where you're then going to be able to pull from to repay back that loan and reinvest back into your business. So make sure that as you're looking at financing, you continue the deep exploration, ask questions, do comparative checks, right? Talk to different organizations. You will be able to find one that's the right one for you, that's a good fit for you, and choose the right loan size for what your needs are. Nothing more, and hopefully nothing less.
Thank you, Alethia. Sara.
Yeah, similar. Don't worry about asking what something means or for clarifications. You won't look stupid. I think smart people are the ones who ask questions. So ask questions often and regularly. And if someone is not answering you, stop talking to them. Get another group around you, because that's extremely important, is who you build as your community of trust. And that community of trust can be your lender. That community of trust can be a mentor, but it's someone who, when you ask them a question, doesn't make you feel stupid and doesn't make you feel like you're one more question in a queue of things, etc. Because that's how you build experience. That's how you build knowledge, is by leaning on those you can trust. And so be honest about it for yourself, and it will really save a lot of heartache for yourself in the future. You're not going to know everything. You're not going to know everything all the time. So learn to feel comfortable asking for help.
Great point. And I just can't echo that comment enough. You can see from both Sara and Alethia, they are very passionate about the business owners they work with. So find that right team of advisors, because they can help you through these processes and help you grow and provide that right advice. So thank you, Sara. So we're going to turn to some of the questions we've been receiving through chat. I think this goes back to when we were kind of chatted about, but we had someone outside of the footprint we're talking about. How do they find a CDFI? Are there places online to connect with? Sara, I'll ask you that question.
Yeah, we are both part of our industry network. That's Opportunity Finance Network, OFN.org. You can go there to find a CDFI in your state, in your city, in your county. And also just type in CDFI near me. Yeah, it's starting to catch. So thank you, Colin, for posting that. But OFN.org tells you a little bit more about this sub-industry of the financial, the larger financial industry. But thankfully, word is catching about CDFI. So if you Google or in your web browser, look up CDFI near me, you should be able to come up with something.
Great. I saw an interesting question in chat just come through. If a CDFI is going to say no, where is that next step of organization you go to? Alethia, do you have thoughts on that?
Yes. So I would say because each institution, right, still operates, individually, right? We're, every organization is looking at, key things. They have points that are, that one may say, this is something that we may not be able to consider, whereas another one will say that that's fine. I mentioned and described right at Grameen America differently than other financial institutions, right? We don't use credit scores as an input to the program. It's an output of the program, but it's not an input. So each organization, institution looks at different things. And so if you speak to a CDFI, a particular organization, and for whatever reason, they cannot proceed with providing you with a loan, I would try another one. I'd go to I'd go to that list and, and see if there's another organization that's in my area. But also many times, because of the mission focus and because ultimately we want to be able to help you, if it's not me, it's going to be somebody else. And so many times they will be able to pass your information over or provide you with some direction on maybe another organization that you can reach out to. Sorry.
No, I agree with you, Alethia. I just would say, be sure to ask why you didn't get the funds. There could be a reason that, regardless of another CDFI's risk tolerance, is actually something that needs to be addressed. I trust any CDFI you work with, again, because part of our value is to explain the process, that you, even if you can't get an answer from that immediate officer that you were speaking with or associate that you were speaking with, that you can get to the answer ultimately. Why was I declined? And they should be able to tell you why.
Great, thank you. There was also a great question we got in the pre-submitted questions around, can a non-green card holder without U.S. citizenship, can they apply for a small business loan through a CDFI?
The short answer is yes.
Yes.
Yeah. We all get funding from very different sources. We can figure out how, if one funder has issue with that and they don't want to use their capital for that purpose, but not every funder. And so most CDFIs at this point can provide support to I-10 holders, non-US residents, etc.
Great news. I know, Sara, you touched on this, but Alethia, what are the maximum loan amounts? I think we'd said 5 to 50,000 is what we're for both of your organizations, and typically for CDFIs.
Yes, typically for CDFIs, 50,000, is within the realm, because then you start to get into, probably more of the small business size loans, and they go into the hundreds of thousands of dollars. At Grameen, I mentioned that our loan sizes start at $2,000, but obviously there's opportunity to grow. The average loan size is about $4,700, so in and around that $5,000 that an individual can get over the period of a year. And I think our largest single loan issued now is about $18,000 or $19,000. So and we don't have at this point, we also don't have a cap or a threshold in terms of the loan size, the max that loan size can go to. So again, I think it is about, feeling good about a relationship that you formed and being able to continue, with that relationship and continuing to get and tap into the resources that our types of institutions can provide.
Great. Just looking through these questions really quick. So one of the big questions also came out, what are the interest rates looking like for your organizations?
It's been a crazy, however many months. What used to be considered cheap before is not cheap anymore, given how many, what we call subsidies, are coming from the federal government. But presently, our rates have always been somewhere around 9 to 11%. Again, this is your first business loan. It's going to be slightly more expensive than hopefully your future business loans, but because it's spread out over months, years, your monthly payments are, our whole goal is to keep your monthly payments very reasonable. Since COVID, since revenues have been so impacted, we have a recovery product that's at 5%. So depending on what you're looking for, we are somewhere between 5 to 11%.
Great. Alethia, great final question, I think, as we need to wrap up. What are some good reasons to take a loan? When do I stop bootstrapping if I'm a service-based business?
Oh, nice. That's an interesting question. So when do I stop taking a loan?
When do I start?
Oh, when do I start taking a loan? Yeah. Okay, yes. I was gonna say, when do I stop taking a loan? Okay. When do I start taking a loan? So what I would say is that, because I did see a question in the chat also that asked, whether or not I need to be an operating business or not. And, organizations like, Grameen America, we do work with both individuals who may just be starting. So even in a service-based business or any type, because we don't, we leave that to the entrepreneurs to decide what business is best for them. But we don't, there is no expectation that you have to be already operating. The interesting thing though, right, is that, at the end of the day, right, you're taking a loan. So you do have to have the ability to be able to repay that loan. And the goal, would be ideally that, if I'm taking a loan for this business, it's an expense of the business that I'm doing as a part of my investment. And so I will be able to generate funds to be able to repay with. So, simply, if I'm a service-based business, I take a hard look at what are the needs. If, sometimes a service-based business can begin with minimal, requirements upfront. And so in that sense, you may start with, something as simple as, your own savings, or sometimes friends and family can be useful and can be helpful for those things in terms of startup. But at the point where you can take advantage of capital to further your service, right? To push that forward, to be able to drive that and or to help it grow, right? If it helps you to reach a larger market, if it helps you to put in, I'm thinking about COVID and people needing to pivot to online, based businesses where technology started to become more of an integral need. And so sometimes boosting up the digital capabilities is where, sometimes funding sources are needed for. So take that hard look at specifically what you will intend to use that financing for, how that's going to drive the growth of your business and the growth in dollars, right, that you can actually earn, so that you put yourself in a position where you can continue to afford to manage that loan and be successful with it.
Great. Thank you so much, Alethia. Thank you, Sara. I'm such a privilege to get to work with both of your organizations and how we can further business owners as they start their journeys. So Colin, back to you.
Paloma, Sara, Alethia, thank you so much. There was a lot that we covered in that, but it was all super valuable to help the entrepreneurs in our community understand the alternative funding mechanisms out there to help them, the keyword here, grow their businesses. So really appreciate you guys taking the time to share your wisdom, and thank you everyone for joining us. We hope you can join some of our future webinars that are coming up. So take a look out for those soon. But again, Paloma, Sara, and Alethia, we really, really appreciate you guys sharing your time and wisdom and treasure of all the amazing things that your organizations are doing. So appreciate you all, and we look forward to seeing all of you online soon. Have a good one, everyone.